Here's something strange about Marvell Technology that almost nobody talks about. Insiders, the people actually running this company, own just 0.18% of it. That's less than 1/5 of 1%. Meanwhile, big institutions, the hedge funds, pension funds, and mutual funds of the world own 78.11% of the entire company. So who's really driving the direction of this stock? Stick around, because by the end of this video, you'll understand exactly what that ownership gap is telling us, and there's a much bigger contradiction hiding deeper in the numbers. Let's start with the size of this business. Marvell currently carries a market cap of $165.24 billion. Market cap is simply what the entire company is worth if you multiply the share price by every share out there. But when you add in the company's debt and subtract its cash, you get what's called enterprise value. And for Marvell, that number is $166.67 billion. That's the real price tag if someone wanted to buy the whole business outright, debts and all. Now here's where it gets interesting. Over the past 52 weeks, Marvell's stock price has climbed by 166.31%. That's not a typo. The stock has more than doubled in a single year, but before you get too excited, there's a catch. The stock's beta is 2.20. Which means this stock swings about twice as hard as the overall market in both directions. When the market goes up, Marvell tends to go up faster, but when the market drops, Marvell tends to fall harder too. So that huge run-up comes with real turbulence attached. At first glance, a stock that's doubled in a year sounds like a screaming success story. But here's where investors often get confused. The trailing price to earnings ratio, or PE ratio, which basically tells you how many dollars you're paying for every $1 of the company's past profits, sits at 65.17. That's expensive by almost any standard. However, the forward PE, which uses expected future earnings instead of past ones, drops to 41.55. That's a massive gap, and it tells a story on its own. The market is betting that Marvell's profits are about to grow significantly, and the data backs that up, with analysts forecasting earnings per share growth of 47.99% over the next 3 years. But that's not even the most surprising part. Let's talk about efficiency, because this is where the numbers start to disagree with each other. Marvell's return on invested capital, or ROIC, which measures how well the company turns the money it raises into profit, is 6.87%. Sounds decent on its own? But the company's weighted average cost of capital, or WACC, the actual cost of raising that money in the first place, is 15.93%. In plain English, it currently costs Marvell more to borrow and raise capital than what it's earning back from that capital. That's a gap most casual investors never even look at, and it's a genuine red flag buried underneath an otherwise exciting growth story. Now let's flip to the balance sheet, because this is where Marvell looks a lot stronger. The current ratio, which compares what a company owns short-term against what it owes short-term, sits at 3.28. Anything above 1 generally means a company can comfortably cover its near-term bills, so 3.28 is a very comfortable cushion. Debt to equity is low at 0.29, and interest coverage, which shows how easily a company can pay the interest on its debt using its operating profits, is 6.92 times. Marvell also holds an Altman Z-score of 5.8. Without getting too technical, this score estimates the risk of a company heading toward financial distress, and anything above roughly 3 is considered a safe zone. 5.8 is well into that safe territory. So how does the actual business look on paper? Over the last 12 months, Marvell brought in $8.72 billion in revenue, and turn that into $2.53 billion in net income. That's the profit left over after every single expense, including taxes. Gross margin, the percentage of revenue left after just the cost of making the product, is 51.5%, meaning for every dollar of sales, about 51 cents remains before other expenses come into play. But by the time you reach the bottom line, the profit margin settles at 28.99%. Still a healthy number, but a reminder of how much gets absorbed along the way by operating costs and taxes. Here's another twist. Marvell generated $1.67 billion in free cash flow, which is the actual cash left over after running the business and paying for equipment and investments. That sounds solid until you compare it to the enterprise value. The EV to free cash flow ratio comes out to 100.08. That means investors are currently paying about 100 times the company's yearly free cash flow just to own this business at today's valuation. That's an incredibly rich price tag, even for a fast-growing company. And what about the dividend? Marvell pays out just 24 cents per share annually, working out to a dividend yield of only 0.13%. The payout ratio, or the portion of profits paid out as dividends, is a tiny 8.29%, which tells you this isn't a company built for income investors chasing dividend checks. Meanwhile, shareholder yield, which combines dividends and buybacks minus new shares issued, actually sits at negative 0.87%. That circles right back to where we started, because shares outstanding have actually increased by 1% over the past year and by 4.33% just in the most recent quarter. So even while paying a small dividend, the company appears to be issuing more shares than it's buying back. On the other side of the coin, Wall Street remains largely optimistic. 43 analysts currently cover Marvell, and their average price target sits at $252.56, which is 33.86% above the current price, with a consensus rating of strong buy. Short sellers, the investors betting against the stock, also appear to be backing off, with short interest dropping from 39.31 million shares to 34.08 million shares in the past month. So where does that leave us? On one hand, Marvell shows real financial stability, a strong current ratio, manageable debt, healthy margins, and a very safe Altman Z-score. Wall Street analysts are largely bullish, and earnings are expected to grow sharply in the years ahead. On the other hand, the stock trades at a steep valuation across nearly every measure, from its price to earnings ratio to its price to free cash flow. Its return on invested capital currently sits below its cost of capital, and share count keeps quietly climbing even as the company hands out a small dividend. With insiders owning almost none of the company and institutions controlling the vast majority, the real question worth sitting with is this. Is Marvell's next chapter going to be written by the fundamentals catching up to the price, or by the price finally catching up to the fundamentals?